I now believe the housing market will be broken for a decade. And I'm going to pull up the 53-year spreadsheet to show you exactly what I'm talking about.
People know that they have this low rate locked in on their home that they can't move without, giving up a really low rate and probably paying more just to rent or to buy something smaller.
Guess what the cumulative nominal increase in housing is from 1978 to whenever that was, 1996? Because everybody says transactions down, prices have to collapse. Anna, what do you think prices did over that 18-year period? Folks, just in case you haven't heard, Mohammed El Alarian is getting credit in the last 48 hours for declaring the housing market is broken. I feel a little insulted because we have been talking about that for a year, but undoubtedly he will be quoted in the news media for years to come about the housing market being broken. So, when in doubt, I want to go deeper with you. I now believe the housing market will be broken for a decade. And I'm going to pull up the 53-year spreadsheet to show you exactly what I'm talking about. In order to have this conversation, I have the one and only Anna Kelly back with us. How you doing, Anna?
I'm doing great. I thought the same thing, Michael. I saw when El came out, and I said, we've been talking about this for at least a year,
Where have you
if
been,
not
Mohammed?
longer. Exactly. And where was the Fed that they didn't realize that they broke supply and not just demand?
Exactly. And that's what a lot of people have missed. A lot of people don't understand, frankly, that supply and demand is a two-step function. Everybody was
Yes.
focused on demand, affordability, all of those things. And they just didn't get it, Anna, that people aren't going to sell, interest rate lock-in, whatever you want to call it. And we're now trending at lifetime low listings.
Absolutely.
Logan from Housing Wire reports them every Friday or Saturday. And last week we took an almost 10% drop week on week. Listings are going down, right? Rates are above 7.5. No demand, no supply. So I want to bring
Absolutely.
up.
And you know what else is at really long time lows, over 20-year lows? I think it's 2000 or 2002 is the number of housing owners in a serious risk of default. It's
Yeah.
the lowest that it's been, I think, since 2002, in 21 years, pre-Great Recession,
Yeah.
pre-housing collapse, pre-pandemic. So people know that they have this low rate, locked in on their home that they can't move without, giving up a really low rate and probably paying more just to rent or to buy something smaller. So people are making and prioritizing their house payments. So that
Absolutely.
also further brings down supply and keeps prices unaffordable and high.
Yeah. I don't know if you saw this. I think I talked about it last week. There's something called the I almost call it the blended interest rate, effective interest rate. Do you know what the effective interest rate is for all mortgages? So throw all the more residential mortgages in one bucket, figure out the average. Do you know what the average is or the effective interest rate is today? Just take a wild guess.
Of all existing mortgages,
All existing residential
I
mortgages.
would guess 4%.
Very good. It's actually 3.6.
Okay, a little bit less. Good.
Yeah, and you know what the real bad or the real crazy thing is? If you're a guy like me and you know that roughly 30% of single family homes don't have mortgages, if you throw those numbers, it actually brings the effective interest rate sub 3%.
Wow.
Think about
Wow.
that. No wonder
It's
everybody's staying and affording and there's no distress.
right. I mean, we're literally more than double that with today's interest rates. And you cannot double interest rates without making a substantial impact on the payment. And in a lot of markets, a lot of deals that I'm looking at, it's a 50% increase in your mortgage payment just because
Yeah.
rates have doubled.
And that's why transactions crash 40%.
Yes.
And I'm actually on record saying that I think transactions are going down another 20%. We're going to be below 4 million, at least for the month of August and September, which will be reported. The first number comes out in about 3 weeks on September 21st. But let's get back to the topic at hand. For a long time, I've been thinking the housing market was going to be broken for years.
Hmm.
I now think it could be a decade. And it's the 53-year spreadsheet that made me see this. So when I tell you the housing market could be broken for a decade, how does that just feel crazy to you, or what do you think?
It doesn't feel crazy to me. I think that we've had more than a decade of basically, expansion, historically long expansion period when you compare, expansions and contractions over time. It's the longest since President Abraham Lincoln was in office. And I may be getting older, but I'm not quite that old.
Not that old.
And so, I think that we've had this big run up in asset values across all assets, including home values. And so that's not going to last a long time. And if you look at kind of where interest rates are and all the values that are interest rate sensitive, it would not surprise me. And a lot of economists believe we're going to have a lost decade where no values really go up substantially, where we're kind of flat over the next 10 years with a little bit of lumpiness in between. So that doesn't strike me as like, oh, Michael, you're way overblowing it. It's, just bad news. It's a reality that the next decade is not going to likely be as prosperous for asset values as the last decade was. So it doesn't strike me as crazy. I would hope, though, that it wouldn't quite last a decade, that we have our downturn, that we have our recession, that some of the, chaff is taken off the top. But with housing, like you said, when there are so many homes that are locked in at 3.6% average, I don't see many homeowners moving for a very long time unless rates came back to the zero bound and prices came back down. So could that happen the next 10 years? Yes, but I'd love to see your spreadsheet and the data that's making you think a decade.
Yeah, it's so Mohammed, if you start saying housing is broken for a decade, I want credit, buddy. So here we go. You've seen this, folks. Again, you can get this for free. I think it's so valuable. It's on my website, one rental at a time. Just so you know, all the data sources are listed here. St. Louis Fed, blah, 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 blah. It's all there. So not my numbers, not made up. They're here. So where I start with this, Anna, is interest rates. That's line 9 here in yellow. In 1978, rates were 9.6. And as you see, it took over a decade for rates, the mortgage rate, to get below 9.6. That's where I start. This is the Fed higher for longer, right? Today, Anna, I think people are thinking it's months and quarters. The Fed really could be higher for longer for a year and a half, 2 years. So that's where this starts. Does that make sense?
It does. And I think that the Fed is unlikely to really cut rates back to where they've been in the last several years because there is more inflation on the horizon. So I want to venture to say higher for a decade. We're not going back to 3.6% interest rates, in my opinion, for a very long time, if ever, unless we have major deflation and economic global collapse, and they have to go back to the zero bound. I don't think they go back down. Now, thankfully, we're not up in the 13, 16% ranges like we were in the early 80s. But, I think that the Fed's going to hold rates and even when they cut, not go down substantially to where we were before.
Yeah. So again, higher rates for longer, right? The Fed says that now people have a gauge of what that might mean. So where I go to next is transactions, because that's what I called and, have been proven right. And again, Mohammed will get credit for it. But we start 1978 at 4.8. But look at this. How long does it take? And this is light blue. Hopefully you can see it. For us to get back to 4.8 total transactions. Anna, it's 1996.
Wow.
1996.
Wow.
That's 18 years. The entire decade of the 80s was below 1978 transactions. That blew me away. That's wild.
It is. I have an idea, a hunch of why, though. Okay. I don't think it's just interest rates, because if you look at the 1970s, especially the early to mid 1970s, this was the time when the baby boomers were buying homes. So they were the workforce, but they were also the, huge number of new home buyers in the early 70s. And that's part of what created the mass inflation, that you had so many new people entering the labor force, spending money, buying homes. And so I do think that those numbers, those high numbers in the 1977 and 1979 range, I think that was household formation. So
Could be.
I agree that the interest rates had a big impact on people not buying homes for a while. But if you look before that 70s, you were kind of in the 3 million home range. So I'm curious,
Yeah.
you know, from 75, 76, 3 million, 3.7, when did it get back to that after the rate hike started in 78?
So when did we get back to 3 million? So 83.
83.
Yeah.
So,
Yeah.
that's a little bit more hopeful, 5 years versus a decade. If household formation, because of ages and also because of interest rates came down a little bit.
Yeah, this 77 to 78 is shocking to me. We basically added a million transactions
Yes.
between seven. It's just wild. It's
I
just
think
wild.
that's why, though.
It could be. Yeah, absolutely. I got to look into that. I got to look at household formations. That's something that's not on my spreadsheet. But you know what? I can go get it and we can figure it
I
out.
would love that because that's something that I've really been watching when I hear, kind of talking heads and pundits saying this is going to be just like the 70s. The 70s is the most recent similarities to kind of what's happening now in terms of high inflation and the rates going up. But the thing that is really, really different is the number of people starting households and the number of
Yep.
people actually buying homes. Because even though we have the millennials, on the fringe of starting to enter home buying ages and starting to buy more,
Mhm.
that's kind of pulled back, but it's still not nearly the population group that we had in the late 70s. So I think it would just give us a little bit of nuance to
Yeah,
add that and just say, hey, how
we
much
can
of
look
that
that up.
is formation versus the rates? But either way, even if you just don't have as many people buying, I have no doubt at all that the high interest rates slowed down anyone that hadn't bought, in the mid to late 70s to go, okay, now we're really going to hold tight for a while.
Mhm.
And you can see clearly that took at least 5, 6 years to get back to where it was before 77.
Mhm.
And then, till 1985, 86 before you really get close to where you were in 78. So I think you've got at least a 5-year run, even
Right.
if you account for some of that baby boomer house purchasing. But to your point, up to maybe 10.
Yeah. So then the big one, right? Everybody wants to talk price. I've been talking transactions. We've been right about that. So what I did is I went and summarized nominal. So we just nominal home prices because that's what most people think about.
Yes.
Guess what the cumulative nominal increase in housing is from 1978 to whenever that was, 1996. Do you have a guess what happened to prices? Because everybody says transactions down, prices have to collapse. Anna, what do you think prices did over that 18-year period?
I think they probably were in the 6% range.
So what do you think the cumulative is? So six
Oh,
times 18.
cumulative.
Yeah, cumulative.
Yeah, 100 and what is that, 108%?
Yeah, you're look at you. It's like you've done this before. Are you cheating? Do you have the
No,
spreadsheet up in
I'm
front of you?
not.
I know.
I don't, I'm not.
I'm just teasing. So cumulative 110, average
Wow.
5.8. You are good.
I
Just for
study a
fun.
lot like you, Michael, right? That's why we
Yeah.
try to do this show and help people. But, it is lumpy. And if you
Yeah.
look at your spreadsheet, you can see that initially
Yeah.
home values started to fall a little bit, but
Hmm.
then, it's kind of like the consumer gets used to, okay, it's still high, but it's getting a little better. So let's start, buying more houses. So but I think we probably had a little bit more. I'm not sure. I think we had a little bit more supply
Yeah.
a little earlier, but people do kind of, get used to rates being higher and eventually
Yeah.
they still have to move. And so if you have a little bit of a lack of supply and rates going higher, you're still going to have an increase in home prices.
Yeah. So again, that was very much nominal, right? 110 or 5.8 kind of average. I just added up the real, right? So inflation adjusted was only 11%. for that entire 18-year period, which is sub 1%,
Right.
basically 1% over inflation, which is kind of the historical average. So
I was going to say, I remember when we looked at this before, and I was a little bit surprised when we adjusted for inflation that over the last 50 years, when you first started to create this spreadsheet, that inflation adjusted home values generally have gone up about 1% per
yep,
year on
of
average
inflation.
over 50 years. Right. So
Roughly.
that's kind of a number that it can give you hope that home prices are still going to go up. So, if you're investing in homes today, it's not like you're going to have forever a 10 or 20% crash in values. Even if it happened in a year or two, it's going to be lumpy and probably average out to at least 1% per year,
It, I,
inflation adjusted.
it's, you know this, but I'll say this for the audience. It's even better than that because your loan is a 30-year loan that stays in nominal
Yes.
terms while your payment goes up inflation adjusted. So you're
Right.
paying off debt with cheaper dollars. It's almost like
Absolutely.
somebody has a shirt that says, I use inflation to get rich. Ask me how. Right. I mean,
Right.
it's,
Absolutely. And that's one of the arguments I like to have. As you know, I was in private banking for years in the late 1990s. And, you'll have people that'll say the stock market has outpaced real estate. Well, they're only looking at home appreciation rates. They're not
right.
taking into consideration, the cash flow and the mortgage pay down as well. And that's one of the powers of using leverage for real estate when you have a positive leverage environment like we've had over the last 15 years or so.
Yeah. So at the end of the day, Mohammed, if you're watching my shows to get your material, I think the housing market will be broken for a decade. You can talk about rates, transactions, inflation, all of that if you'd like. But thank you for bringing it out. Thank you for quoting me. I appreciate it. Anna, where can people find you?
Great. You can find me here on your channel most weeks, and you can find me at social media at Anna Kelly REI Mom and my website reimom.com.
Awesome. Thank you so much.
Thank you.